Performance reporting. Performance reporting is a term that can be used to encapsulate many different accounting standards, as well as some common sense thoughts regarding the interpretation of financial statements. In this session, we shall therefore explore changing accounting policies, IAS 8, operating segments, IFRS 8, first-time adoption, IFRS 1, and interim reporting, IAS 34. We will also briefly discuss ratio analysis and the limitations of financial statements when it comes to understanding the performance, position, and adaptability of the entity. IAS 8 Change in accounting policies and material errors. It is important to note that a change in accounting policy can only occur when it is demanded by a new accounting standard or when the new policy gives a truer and fairer view of the situation. It goes without saying, therefore, that a new policy cannot be adopted simply to increase the reported profit for the year. It is also important to distinguish between a change in accounting policy and change in accounting estimate. A change in accounting policy must be applied retrospectively, although some of the new accounting standards do offer limited exemption from this. And change in accounting estimate must be applied prospectively. Retrospective application would involve restating not only the comparative year, but providing a restatement of the opening position of the comparative year. In other words, 3 years' worth of balance sheet. Prospective application simply involves applying the new accounting policy from the current year. We need therefore a way of thinking about an accounting policy so that we know when it has changed. A policy therefore can be thought of as being made up of 3 elements. The first is recognition. Do we include it in the financial statements? And what element do we include it as? Asset, liability, income, expenditure, or equity? The second is where in the financial statements the item is presented. And the third is the basis that we use to measure the item. A change in accounting policy could be indicated by a change in one, some, or all of these factors. A certain element of judgment is required. The big picture is that the restatement of comparative information means that the comparative information still serves its purpose, which is to provide a context for understanding this year's performance. If the comparative information is so different from the current year, that is a very good indication of the need to treat the item as a change in accounting policy. There are some common examples to which we can apply the aforementioned theory. Consider changing from straight-line depreciation to reducing balance depreciation. This involves no change in recognition or presentation. However, people will often argue that there has been a change in the measurement basis. However, whether we use straight line, reducing balance, or machine hours, we are simply trying to measure the amount of economic benefit consumed, and therefore there has been no change in the measurement basis. This would simply be treated as a change in accounting estimate and applied prospectively. Another common example would be reclassifying an item of expenditure from cost of sales to administrative expenditure. It could be argued that this constitutes a change in accounting policy, since there has been a change in presentation. The reclassification has had a direct impact on gross profit, and therefore presentation has changed. This would indeed be true in an industry where gross profit is treated as a key performance indicator. However, if gross profit is not a key performance indicator for the industry, then it could also be argued that there has been no change in presentation. A certain element of judgment is required. When assessing a change in accounting policy, therefore, it is always important to think about the impact it has had on the reported position and performance, and whether, given the circumstances, the entity has applied the appropriate technique of retrospective or prospective application. In addition to a change of accounting policy, The other reason that can cause a company to change the comparative information is a material error in last year's financial statements. This will, of course, prevent the comparative information from serving its purpose. It is perhaps worth noting that the error need only be material. By way of comparison, in old UK GAAP, the error had to be fundamental before a prior period restatement would be triggered. IFRS 8 Operating Segments. IFRS 8 Operating Segments is essentially a standard on risk. By analysing the entity's performance in relation to the products it sells or the geographical areas that it sells those products in, this gives the user a better understanding of the risk to which the entity is exposed. The standard is very clever in that its focus is on what is of relevance to the entity. Essentially, the entity reports its segments in the same way that it does for internal management accounting. After all, if this is how risk is reported internally, then it would surely make sense to report to the shareholder on the same basis. Furthermore, allowing the company to report externally on this internal basis makes the preparation of the financial statements much easier, as the information disclosed in the statutory accounts can be presented as it is in the internal management accounts, with an overall reconciliation back to the statutory accounts. This is far simpler than previous standards that required internal management information to be restated on an IFRS basis. This therefore helps us to understand the definition of an operating segment as one in which discrete financial information is available and one whose results are regularly reviewed by the Chief Operating Decision Maker. The phrase Chief Operating Decision Maker essentially means reviewed at a senior or strategic level in the business. In reality, the standard offers entities much guidance in identifying the Chief Operating Decision Maker, which can either be an individual or a team, or people such as a board, committee, or management team. Imagine an entity whose management accounts report by geographical region. This could be, for example, different countries within Europe. The entity would then have to decide which of these countries were significant to the business using the 10% rule. It is hard to define significance, so the standard says that significance could be based on revenue, results, or assets. If the revenue of the segment accounts for more than 10% of the total external revenue, if the assets of the segment account for more than 10% of the entity's assets, the segment is significant and becomes reportable as an operating segment. With regard to performance, the entity adds up all the segments in profit and all the segments in loss and picks the biggest number, irrespective of positive or negative. 10% of this figure is then taken, and if the results of the segment exceed this level, the segment becomes reportable. An operating segment need only be significant in one of the three criteria to become a reportable segment. To be a reportable segment, therefore, discrete financial information must be available, the results must be reviewed by the Chief Operating Decision Maker, and the segment must exceed the 10% rule in any one of the three criteria. Once the entity has performed its initial identification of operating segments, it must then add up the external revenue of these segments and make sure that this exceeds 75% of the external revenue of the business. If the total does not, the entity must identify further operating segments by making segments that were below the 10% rule reportable. Further segments must be added until more than 75% of the external revenue of the entity has been separately reported. Items of disclosure for an operating segment include revenue, finance income and cost, depreciation, amortization and other material non-cash items, share of profit under equity accounted investments, profit or loss as reported to the Chief Operating Decision Maker, tax, assets, investments in associates and joint ventures, expenditure on non-current assets, and segment liabilities. The entity must also disclose external revenue by each product or service, geographical information, and information about major customers who account for more than 10% of external revenue. The standard identifies a practical limit of 10 segments, as to report further segments would lose some of the strategic focus. It also, however, states that any segment may be reported separately if to do so would give a better understanding of the entity. Whilst the standard only applies to listed entities, it is worth noting that the new revenue standard, IFRS 15, which applies to all entities, requires a breakdown of performance of the entity. The way in which this performance is split down is left to the discretion and judgment of management. IFRS 1 First-Time Adoption. IFRS 1 covers the process by which an entity makes the transition from a non-IFRS GAAP to IFRS. Imagine an entity has a 31st of December year end and decides that, as from 2015, it will report under IFRS. The first full year of adoption is therefore the year ended the 31st of December 2015, making the comparative year the 31st of December 2014. The first day of the comparative year is the 1st of January 2014, and this is known as the transition date. At this date, the entity must provide a reconciliation of the balance sheet under old GAAP to IFRS. A reconciliation must also be provided of the comparative year profit, which would of course have been originally filed under old GAAP. And at the 31st of December 2014, a reconciliation of the balance sheet, as this would be the final balance sheet under old GAAP. Together with the numerical reconciliation, suitable narrative disclosure must be provided to explain the key items of reconciliation. Perhaps the most useful of the reconciliations is that of profit. Often, stakeholders, both internal and external, will want to know whether the reported profit will increase or decrease as a result of following IFRS. The good news of IFRS 1 is that it is designed to make the process of transition as easy as possible. It does this by allowing certain exemptions from full application of IFRS at the transition date. An example of these exemptions includes allowing the entity to use fair value at the transition date as deemed cost, where original cost information is not held by the entity, and by not requiring the restatement of business combinations that occurred prior to the transition date. Restatement may involve complex adjustments to goodwill for which the entity does not hold the required information. Other exemptions include those that relate to borrowing costs, foreign exchange gains and losses, adoption of IFRS by subsidiaries, associates, and joint ventures. IAS 34 Interim Reporting. IAS 34 is applicable to those entities who have to produce an interim set of financial statements. As a minimum, these financial statements would need to include a condensed statement of financial position, a condensed statement of profit or loss and other comprehensive income, a condensed statement of cash flows, a condensed statement of changes in equity, and certain explanatory notes. In terms of comparative information, we see the following. A comparative balance sheet is provided at the end of the preceding financial year. A comparative profit or loss and other comprehensive income for the comparative interim period and the comparative year to date, and a comparative cash flow statement for the comparative year to date period. Notes include those which are significant to the understanding of changes in financial position and performance since the last annual report, and information about seasonality estimates, and unusual items. Ratios. With the exception of earnings per share, ratios are not governed by any reporting standard, and therefore, whilst ratios can be exceedingly useful in understanding an entity, care must be taken in the way in which they are used. For example, the balance sheet is at one point in time and may not capture the peaks and troughs and seasonality of the business. The significant judgment applied in the application of accounting standards and the summarized nature of financial statements means that a comparison between two entities may not be a direct comparison. It must also be remembered that what appears bad for the business in the short term may be indicative of investment for the long-term success of the business. And the success of any strategy is dependent not just on the financial success, but also the non-financial success. Ratios are not capable of measuring concepts such as brand perceptions. Where ratios are being used for interpretation, we must think about what is relevant for the entity in question. For example, a young company in a high-growth industry will be focused far more on liquidity, as growth will need to be funded in order to maintain and build market share in an industry which is constantly growing. A mature company in a mature industry will have the ability to generate a lot of cash, but with a saturated market will only be able to improve results by reducing expenditure, and therefore profitability becomes a lot more relevant. A company wishing to undertake a new strategy will require financing, either from debt or equity, making gearing a very relevant measure, and a listed company will attach far more significance to investor ratios compared against a company who is not listed. There is a lot to be said for a management commentary of performance. This will provide an overview of current performance, position, and liquidity from a strategic level through the eyes of the board of directors, and provide an insight into future risks and challenges faced by the entity in pursuit of its strategic goals. The advantage of such a narrative report is that it can provide the information that cannot be provided by the financial statements alone. The downside is that narrative is not precise. It can be used emotively and to make things sound perhaps better than they actually are. Financial analysis must therefore include an appreciation of the limitations of the financial statements on which it is based, and the use of supplementary information with the correct amount of professional skepticism to enhance the financial analysis. Another increasingly significant area that is used to assess the performance of the entity is that of corporate social responsibility. This essentially reports on issues concerning the environment, the treatment of staff, and the treatment of key stakeholders. In terms of the environment, this may include issues of consumption of raw materials, pollution from production, and replenishment of the finite resources which have been used in the pursuit of strategic objectives. As this is a relatively new area of reporting, it is not yet governed by reporting standards. However, it is fair to say that we are beginning to see the development of guidance frameworks, such as the Global Reporting Initiative, which provides guidance on both general and specific points. A good CSR report will include objectives which are smart, rather than simply sound bites, and a report which provides internal and external comparative information. Furthermore, the report must not be afraid to highlight where objectives have not been met, and the actions that are being taken to address the shortfalls in achievement. Improvements in CSR may take time and may require a high level of investment. Both of these can be off-putting to the board of a company, but they are likely to achieve an increase in share price and brand perception. Or perhaps more importantly, if nothing is done, share price and reputation may be damaged, which can be very detrimental to the business.